Thanks for clicking. My name is Mark Mitchell. I'm a mortgage broker here in London, Ontario. A new report issued by the Bank of Canada shows that Canadian real estate is being increasingly bought up by real estate investors and current homeowners.
Yeah, no Sherlock.
And on the flip side, that first-time homebuyers are being increasingly pushed out of the market, reaching its lowest share of the Canadian real estate market ever. For its part, the report also goes over who is holding all of the mortgage debt in Canada, and I think this is going to have some big implications for the Canadian real estate market in 2022. As we've all seen over the past few years, Canadian real estate has skyrocketed, and many have been wondering who is doing all this buying and where are they getting the money. And this report definitely sheds light on all of that. So what I want to do is get into the report, show its conclusions, and talk about what it means for the future, as I think this report shows that we are definitely in for a very different 2022 once interest rates start to rise. Speaking of 2022, Stats Canada is set to release its inflation data on Wednesday, and we'll be having an update out on that right away, with the Bank of Canada set to release its interest rate policy on the 26th of January. This inflation data will no doubt be largely contributory to whether or not we raise rates now or if we raise rates in March.
Or maybe never.
We also have an update coming out at the end of the month on the Bank of Canada's monetary policy report, which will probably have some predictions for the Canadian real estate market in 2022. If you want to get all of those updates, make sure you click like and subscribe. But for now, let's get into this report. The report found that first-time homebuyers lost the largest share of the real estate market over the past few years, as their share of total home purchases shrunk down to around 46% when it was at around 52% in 2015. So first-time homebuyers saw their total share of the real estate market shrink by at least a little over 6 percentage points in the last 6 years alone. In contrast, repeat homeowners, those that already own a home, sold it, and bought another one, saw their share increase by about 1% over the past year, up to 32.64% of the market. So, first-time homebuyers have seen their share shrink. Repeat homeowners have seen their share go up at least by a little bit, but only by about 1% over the past year. I thought this was very noteworthy in the report, as it does kind of fly in the face of what the Bank of Canada has been saying for the past couple years, especially since the pandemic hit. We've seen Tiff Macklem many times say that demand has gone up for housing by so much as current homeowners wanted upgrades. Current homeowners wanted more space as the lockdowns came down.
Pandemic has actually increased demand for bigger houses because we've been spending so much time at home. People are working at home, children are studying at home, people want bigger houses.
1% isn't nothing. A 1% increase isn't nothing to shake a stick at.
That's not nothing.
But still, 1% does not account for that kind of demand increase that we've seen over the past few years. So this report does kind of shine a light on that. It wasn't the repeat homeowners that caused this increase in demand. It was, and we're going to talk about this in a second, it was the real estate investors. Well, real estate investors only accounted for about 18.7% of the real estate purchases in Canada as of March of 2020. By June of 2021, they accounted for 20.58% of the market, nearly a 2% increase in the amount of property held by real estate investors. And I think the idea that real estate investors are accounting for more and more of the market at the expense of first-time homebuyers is really borne out when we look at the 2015 data, also included in the report. 2015 was when first-time homebuyers held the largest portion of their share ever of the Canadian real estate market. At that point in time, real estate investors only accounted for a little over 17% of the market. So since 2015, we've seen these investors bump their share up from 17% to close to 21%, a 4% difference. And we've seen first-time homebuyers see their share shrink by around 6%. So we can really see that's where the demand has shifted. It's definitely shifted to those real estate investors away from those first-time homebuyers. Looking at this data at first glance, I think, yeah, of course, money was cheap. Money has been cheap since March of 2020. No wonder the real estate investors are taking advantage of that, and they're buying up property. They're putting their money into real assets, into assets that will move right along with inflation. And this report definitely seems to bear this out. While real estate investors have increased their share of the Canadian real estate market dramatically, they've also increased their debt dramatically.
What did?
As this report shows, the debt-to-income ratio is the highest amongst real estate investors, second highest amongst repeat homeowners, and the coming in last was first-time homebuyers. So first-time homebuyers, although they have seen the amount of their share of the real estate market shrink, they're also in a much better debt-to-income ratio than are repeat homeowners or real estate investors. First-time homebuyers, in large part, unless they have a gifted down payment, can't buy as much as the real estate investor who obviously is a bit more well off financially, or the repeat homebuyers, those who already had a house, so can sell their house to get that larger down payment to buy that leveled up house. So, I mean, obviously they are going to hold more debt, but the implications for this are very interesting when we look towards 2022. It's pretty obvious to just about everybody that the writing is on the wall, the party is over, interest rates are coming to a theater near us.
It sucks.
Many are calling, including JP Morgan just last week, for the Bank of Canada to raise interest rates on January 26 when they make their interest rate announcement. As the US has hit 7% inflation, more and more pressure is being put on the Bank of Canada not to let that happen to Canada. We might be too late, we might be a little late to the party, but we'll definitely see. But regardless, whether or not it happens in January or if it happens in March, many are calling on the Bank of Canada to speed up the pace of these interest rate hikes. The Federal Reserve has already said that we're probably looking at 3 to 4 hikes, and it's all over the news. It's been in the markets that interest rate hikes are coming. Those who hold the most debt are going to be the most negatively impacted by these interest rate hikes, especially. In my experience, a lot of real estate investors do go with variable mortgages, only because the penalties are so much cheaper if you decide to break the mortgage, if you decide to sell the house. So these interest rate hikes are going to hit these investors, I would assume, to be the hardest when they start coming down the pipe, depending on the speed and the severity of these hikes. First-time homebuyers, many of them tend to go with 5-year fixed. So if they bought houses over the past 2 years, well, they're not really going to see the effects of those interest rate hikes for the next few years. But the real estate investors probably will. What happens next is anybody's guess, but if rates start to go up more and more, and the investors do start to feel the pinch, we could see them start to sell their properties and start to, I wouldn't say, they wouldn't crash the market, I don't think they have that kind of power as of yet, but I could see the market starting to be flooded with more and more properties, as it's no longer financially viable for these real estate investors to hold on to their properties. That, combined with the fact that the Trudeau government has announced that they will be looking at making it more difficult to buy a house as a real estate investor, they're looking at increasing those down payment requirements. Right now it's at 20%. They could increase it to 35% down payment requirement. That's going to put even more pressure on these real estate investors, and I would assume that it will drive down the demand of these investors in the real estate market, which should help cool us down at least a little bit. So while the report says that the investors have definitely increased their share of the Canadian real estate market, I would expect that rising interest rates and new rules coming down from the government will probably reverse that trend in 2022. We'll have a better idea what that trend is going to look like as our inflation data comes out and as we get the monetary policy report from the Bank of Canada at the end of the month, and we get the interest rate hike announcement at the end of the month as well. If you want to get those updates, click like and subscribe, and thanks so much for watching.